Hi, I'm Marcel with Guaranteed Rate, and I want to talk to you for a moment about something that's very unique when someone is buying a new build, and that is going to be the difference between improved and unimproved taxes. So let me explain that first, then I wanted to go through some of the numbers with you so you can see exactly what the difference looks like. So if you're purchasing a home and the last tax assessment was done on just the land, then that means right now it is considered unimproved, meaning that the county has not gone out yet and assessed the entire market value of the land and the home. It is still unimproved, so it's going to end up typically being the land only. You also have something called improved. Let's say you're buying a spec home and that spec home has been completed. The county's already been out, which typically they do in October, and now they've designated that this home is improved. That means that when the tax assessment value comes out, it is going to be assessed on both the land and the completed property. So that's going to be the difference between improved and unimproved. Now, if you're buying a new home, you may actually have an option on how you set up your initial payment and your escrow account for that property. And let me kind of explain. So what you can do is you can actually choose to set up a property on unimproved taxes. That means that the last time that the county was out, the house was not completed. It was basically just the land. And so when you set up your taxes, you're actually going to be paying less than the true tax amount is going to end up being once that property is deemed improved. And so that means, let's say if you're buying a house right now in July, the last time that the county was out there was not a house there. So right now the tax certificate is going to reflect unimproved taxes because there was no home. So you can choose to go ahead and close on that property, pay taxes based upon that unimproved value. So let's say in the example that I'm going to use, the taxes end up being $159 a month. That's going to be your unimproved amount. So let's say that you set it up like that. You would end up making that payment all the way through the end of the year. But I would advise you that next year, even if the mortgage company has not updated your payment yet, starting in January, you start to put away the correct amount of money for taxes, which we estimated at $749 a month. So you need to start putting that back every single month, because at some point the mortgage company is going to approach you, ask for the difference because now the property is going to be deemed as an improved property. And so you want to make sure that you do have those proceeds available. Now, in terms of closing, it typically is going to be an easier way to set it up like that. The reason being is because the builder is going to use the tax certificate information, which means that if it's unimproved, they're going to give you credit for unimproved taxes from January 1st all the way up until closing date. And so that's going to be if you decide to close as unimproved taxes. However, let's say that you're worried about an escrow shortage, you don't want to be in that position, and you want to make sure that you set up the taxes appropriately right from the get-go. Well, we can do that as well, and it's called setting it up on improved taxes. And so right from day one, we could set up the taxes and the payment based upon $749.60 as your monthly tax assessment. However, that is going to increase your funds for closing. And let me kind of explain why. And this is something that you really need to understand. So what ends up happening, if we're setting it up on improved, what happens then is when we're setting up that tax escrow, it's going to be 10 months times that tax amount, which is a $749.16. So going into your escrow account is going to be $7,491.60. So that's what's going into your escrow account, so that at the end of the year, your taxes are in there so that the tax bill can be paid. However, the builder is going to tell you, hey, listen, we didn't owe that much for January all the way up until July. We actually owed significantly less because the current tax assessment is on unimproved. So they said, you can go ahead and set up your taxes on improved. However, the credit that we're going to give you is still going to be on is going to be what we're going to end up giving you credit for. So with that, be very, very careful, because what that means is that yes, your payment is going to be accurate. However, what ends up happening at that point is that now the credit you're receiving from the builder is going to be for a lesser amount, which means that you're going to be bringing more money to the table, because again, you're going to be collecting at that full improved value. And so with that, it can change your cash to close from bringing, let's say, $21,600 to $27,600 roughly. So literally, the tax escrow can change significantly, and you really need to be aware of that. So So if you have questions on unimproved versus improved, on exactly how that's going to function, please let me know. I'd be more than happy to kind of go in depth with that and kind of explain everything for you, because it's extremely important for you to understand both on how it's going to affect your payment, what you need to do in the future, and how it's going to affect your overall funds needed at closing. In any case, I'm Marcel with Guaranteed Rate. Please give me a call with any questions. Best number to reach me is 972-672-3246. Again, Marcel with Guaranteed Rate. Thanks.